Hello, partners. My name is Savant. I head the partner business here at Wealthy. Today, we're going to understand how mutual funds work and what all types of mutual fund is there and some terminologies around it. While it's a long, elaborate topic, I'm trying to make it crisp and simple for basic understanding's sake. To begin with, let's understand how a mutual fund structure works. There are investors of different natures. All of these investors give in their money to a mutual fund company. Typically, this mutual fund company is a trust which is owned by the investors themselves. That mutual fund company allocates that money to fund managers, which are also called as asset management companies. Their role is to deploy that particular money into various asset classes or different securities, depending on the objective of the particular fund. Whatever returns that is generated from there is passed on back to the investors. This is how a mutual fund typically functions. Now let's try to understand different types, advantages of a mutual fund. To begin, there are a lot of advantages. The first one to begin with is mutual fund is very well regulated. It is regulated by SEBI and by AMFI also governs it. So which makes it very strong system for investors to make sure that their money is protected across. Next, it's a very transparent mechanism. Whatever investment that's happened in that particular portfolio, wherever number of units, everything is given to them freely at any point in time that they can access that particular information. It is managed by fund managers who are professionally into that same job, which makes it very strong for you to get a better possibility of getting returns out there. It also offers you diversification. For a simple amount of 5,000 rupees, you could even get invested into 30 to 50 stocks portfolio. So that makes it very convenient. And as well, you also make an opportunity. It's very economic because it is a pooled portfolio. The cost is also shared by most of the people. Profits and losses are also shared by all the investors, which makes it very economical, and the kind of transactions also becomes cheaper. It also gives you easy liquidity for you to pull out your money from, depending on the kind of invest funds that you invested into. You can even take out your money on the same day, or T+1, T+2, or T+3 days, and so that you can take your money back home. Next, you have different varieties of funds which can be allocated into not just into debt and equity. It can be allocated into various other asset classes like gold, silver, real estate as well. It also gives you tax efficiencies because you don't have to pay transactional tax at every transactions that is happening, but you will pay only a tax at the end of the tenure when you exit that particular fund. Then last, you have it offers also flexibility for you to move funds from one scheme to another scheme, make changes to that portfolio, whatever you want to make, all of that changes would be available to you. Now let's try to understand what are the different types of funds that are there in this. I've tried to classify this based on two parameters, which is risk versus return. First, in the category, we have money market funds, which will invest into very short duration bond papers, which makes very short investors returns for it. More or less, you can be compared to bank FDs. Then you have debt funds, which is will invest into bond markets. Technically, debt money market is also part of the debt, but for easy convenience sake, I have separated it out. Then you have hybrid funds, which will invest into debt and equity. Then you have equity funds, which is, as the name suggests, which will invest into stocks. Last in the classification, you have solution-oriented fund, which will invest with a certain objective in mind. And whatever funds which do not classify into the previous ones are put under others. We'll take into detail one by one. To begin with, let's start with money market funds. The first in the money market funds are overnight funds, which are typically for 1 day kind of an investment. Then you have liquid funds, where the fund manager takes 91 days kind of investment portfolios. Ultra short term funds, which is 3 to 6 months. Next, you have low duration funds, which is 6 to 12 months, and then money market funds, which are for a 12-month period. So this is how you can even match up your investors' requirement to the tenure of this portfolio itself as a simple thumb rule for your investment needs. Next, you have the debt funds. In the debt funds, the first one in the category, which is short-term fund, which is typically for a period of 1 to 3 years. Then it takes into consideration the mid duration fund, which is 3 to 4 years portfolio. Then you have medium duration, where the macula's duration will remain between 4 to 7 years. Then you have portfolios which is long duration for about 7 years tenure investments. Then you have dynamic bond fund. Dynamic bond fund will behave differently during different seasons depending on the interest rate scenario, depending on what the fund manager feels. It could be a short duration fund, sometimes it could behave like a long duration fund in particular timelines. Then you have corporate bond funds, which is also for 1 to 7 years, but the differentiation here is the kind of pay portfolio that the fund manager will hold. Next, you have credit risk funds. This is also long duration fund, but again, the difference here is the fund manager takes lower credit rated funds, which are typically AA and AA minus papers, which makes the risk much higher, and so is the possibility to get higher returns. Last in the category, you have gilt funds, which will invest into government securities. Now, why government securities becomes much higher riskier? Government securities becomes little riskier because it is sensitive to interest rates, and also it is a benchmark, so it is highly volatile in nature. So that is why gilt funds are generally little higher risk, higher return kind of portfolios. Next, before we head on to the equity category, there's something important that I want all of you to know, that is market capitalizations. Market capitalization is very simple. It is the total number of shares that are traded in the stock exchange multiplied by the price of that particular share. So which gives us a output called as a market capitalization. Now, SEBI has defined three market caps for us. One is large cap, mid cap, and small cap. That is the top 100 stocks which are listed and traded in the exchange by market capitalization are called as large cap fund. Sometimes this is also referred to as blue chip funds. Then you have 100 to 250 stocks which are referred to as mid cap funds. Last in the category, the 250 and below are listed as small cap funds. There is also micro cap and various other things, but for our academic interest, we'll restrict ourselves to these three categories. Further on, so this category, we have multi-cap and flexi-cap funds. The differentiation between multi-cap and flexi-cap, both of them would invest into all the three market capitalizations, but the small differentiation is in case of multi-cap, the fund manager has a rigidity to the percentage of allocation that they can do to large, mid, and small caps. While flexi cap, the fund manager has a full flexibility to invest into whichever market capitalization depending on the view that the fund house has. Next, you have tax saving funds. Tax saving funds are typically also multi-cap funds. Only differentiation here is that it is got a lock-in of 3 years, and it also gives you a tax advantage for having invested into these funds under Section 80C, which is up to 1.5 lakh rupees investment that is done into tax saving funds. Next, you have large cap funds. As the name suggests, it invests into large caps. Large and mid cap is a combination of large caps and mid cap. Then you have mid cap funds. Then you have small cap funds, which will invest into small caps. Next in category, you have a unique fund, which is called as your dividend yield funds. Now, dividend yield funds is where the fund manager tries to capitalize on high dividend yielding funds. Now, why is this riskier? This is riskier because during high market times, the dividend yield could become lesser. So that means if you have stayed invested in these kind of funds for a very long duration of time, your returns could become subnominal. Next, you have value and contra funds. The value and contra funds, as the name suggests, value funds where the fund manager will try to buy stocks which are undervalued in nature. And in contra fund, they take a contrarian approach. Let's say one particular sector is not doing well. He'll allocate higher allocation to that particular sector so that when the sector starts doing well, the portfolio returns could become much better from there. Then you have focused funds, which will be concentrated portfolios, generally about 25 to 30 stock portfolios, where the fund manager will allocate this to. So because these are concentrated portfolio, this comes with a little bit of a higher risk. Next, you have sectoral or thematic funds, which will invest into one particular sector or one particular theme, which will make your investments. This could be also be deep cyclical, so you will have to probably have to wait a little longer in case you miss that particular rally. So sector funds comes with a extra risk that's coming. Moving on, we have hybrid funds. First in the category, we have arbitrage. Now, arbitrage is more of a fund which mimics a money market fund in itself, but the only differentiation here is the fund managers tries to get leverage out of the cash market and the future market and tries to get as much as returns that he can pull out from there. But returns typically can be comparable to money market fund returns. Differentiation here would be that you get an equity taxation because it is underlying assets are equity in there. Then you have equity saving funds, which could have 65 to plus kind of an equity plus arbitrage component. Then you have conservative hybrid funds, which are debt-oriented hybrid funds. Balance funds will have 40 to 60% equity. Aggressive hybrid funds will have 65 to 80% kind of an equity. There is also balance advantage in the same category. Then you have dynamic asset allocation fund, which as like what we saw in the dynamic bond fund, here also the fund managers tries to play between the asset allocation that they do between equity and debt, depending on the market view or the sentiments in the market that they have. Next, you have multi-asset allocation funds, which not only invest just into equity and debt, but can also take allocations to high other classes like your real estate, it could be gold, silver, or all of these asset classes, which makes it multi-asset. Next, the last one that is we have is a solution oriented category. In the solution oriented category, as the name suggested, it is for a specific solution. That is, typically we have two kind of products that are available in the market today. One is children gift funds, which are invested for a purpose of children's future educations. It could be for their or could be for their education or for marriage purposes. And then you have retirement oriented funds, which is with specific objective of creating retirement corpus for individuals. Whatever funds which do not fall under the category are classified into others. It could be index funds, ETFs, fund of funds, which could be domestic investments or overseas investments. You also have commodities, which could be into gold. I hope you've understood basics of how mutual fund works and what kind of categories of funds which are there. Now I would hand over it to one of my colleague for you to understand more of some mutual fund terminologies which you should know, which you will encounter on a day-to-day basis of your business. So we'll take that.
Let's dive into some key terms that will help you understand how mutual funds work and how they can fit into your investment strategy. NFO New Fund Offer. First up, we have NFO New Fund Offer. This is similar to an initial public offering or IPO, but for a mutual fund. It's an opportunity for the public to invest in a newly launched fund to raise capital for a specific scheme. The offer is usually open for a set period, with units typically priced at 10 rupees. Once the offer closes, you can only buy the fund at its net asset value, or NAV. This route is often used by asset management companies, or AMCs, to collect funds from investors to buy assets like equities, bonds, and more. NAV, Net Asset Value. Next, let's talk about NAV, or Net Asset Value. You'll see this term frequently. NAV represents the market value of a fund's investments minus its liabilities and expenses divided by the number of outstanding units. Think of it as the price of a share in a mutual fund, similar to how a stock price works for a company. Growth versus income distribution cum capital withdrawal, IDCW options. Now let's move on to the different investment options. With the growth option, any capital appreciation in the fund is reinvested back into the scheme. Investors don't receive periodic payouts, making this option ideal for those who don't need regular income. On the other hand, the income distribution cum capital withdrawal option, or IDCW, pays out any capital appreciation as income to investors. However, IDCW payments depend on the availability of surplus in the scheme, and they are taxable. This option suits those who need a regular income stream from their investment. Switching. Let's talk about switching. Switching allows you to move your investment from one mutual fund scheme to another within the same fund house or AMC. It's a flexible way to reallocate your funds based on changing financial goals or market conditions. Change of broker. Another important term is change of broker. This is the process of transferring your mutual fund investments from one broker to another. The good part, the investments themselves remain in the same scheme, so there's no impact on your holdings, and it won't trigger capital gains. Systematic Transfer Plan. Let's explore the Systematic Transfer Plan, or STP. This allows you to transfer a fixed amount from one mutual fund scheme to another at regular intervals. For example, you can invest a lump sum in a low-risk scheme, like a liquid fund, and systematically transfer a portion of it to an equity scheme over time. This strategy helps manage market volatility and can be a smart choice for long-term investors. Systematic Withdrawal Plan. Next, we have the Systematic Withdrawal Plan, or SWP. With an SWP, you can withdraw a fixed or variable amount from your mutual fund scheme periodically, such as every month. It's a great option for investors seeking regular income. Plus, the tax efficiency is a big plus. Only the capital gains are taxed, not the entire amount withdrawn. Product labeling. Each mutual fund scheme comes with a product label that helps investors understand its characteristics. For instance, you'll find details like the time horizon, short, medium, or long term, the type of product, equity, debt, or hybrid, and the level of risk indicated by a riskometer. This could range from low risk, where your principal is at low risk, to very high risk, where your principal is at a very high risk. AUM, Assets Under Management. Another term to know is AUM, or Assets Under Management. AUM represents the total value of assets managed by an AMC. It includes the sum of all the investments in a particular fund. A higher AUM usually reflects investor trust and the fund's strong performance, while a lower AUM might indicate a newer or smaller fund. Entry and exit load. Next up, entry and exit loads. These are fees you might pay when buying or selling mutual fund units. Entry load is a fee charged when you invest in the fund, reducing the number of units you acquire. Exit load, on the other hand, is a fee you pay when redeeming your units, and it's usually designed to discourage short-term trading. Bull and bear market. Lastly, let's briefly talk about bull and bear markets. In a bull market, stock prices are rising, and investors are eager to buy, hoping to profit from the upward trend. Conversely, a bear market is when prices are falling and investors are selling off, leading to a prolonged period of market decline. And that wraps up our quick guide to some of the key mutual fund terms you'll encounter. Understanding these concepts can help you make more informed investment decisions. Thanks for watching. Disclaimer: this video is only for educational purposes and should not constituted as advice or knowledge in whole. It's only a brief introduction to mutual funds.
You so much. With this, I hope you had a fair bit of an understanding of how mutual fund works. While it is very, very basic, but it is good for you to start off in your business as an elementary level. Thank you so much.